I would just like to start with a little bit of backdrop. So going back about 2 years ago, the public markets started coming down. We then saw about a quarter or two after that growth valuations started coming down and investments started coming down as well. At the end of last year, beginning of this year, A rounds as well, the same pattern. In fact, they still seem to be going down both in investments and valuations from the data that we have. Interestingly enough, seed investing, we haven't seen that drop. There could be a number of reasons because of the number of seed funds. We've seen growth funds and multi-stage funds dabbling in seed as well. It could be AI, for example. So definitely a lot of interesting dynamics going on in the market, and that's why we wanted to bring for the CEOs in the audience and the founders a panel of investors who could give us some perspective on that. So it's about growth, but what I'd like to do is start with Vasant, in fact, because you are the early stage investor on the panel. Now you're going into your 15th year next year at Accel, so clearly that's you've seen quite a bit.
So clearly he's old.
Right, there you go.
To hide in this job at some point.
And so that means also that you started in a downturn as well. So I think for the audience, it'd be great to hear, what's the main conversation you're having right now with your early stage founders when they're thinking about, okay, I need to go and raise an A round or a growth round in the next 6 months, the next 12 months. So what's the main thing that you're talking to them about?
That's a great question. So, I'd say there's two flavors of that conversation. One flavor of the conversation is if you have to go out and raise in the next 6 to 12 months, let's figure out how not to raise in the next 6 to 12 months. And so there are a cohort of companies that are still just figuring their way out in the market, trying to determine repeatability, figuring out their market positioning. Maybe they're building out the team. And I think based on where the funding market is right now, they arguably don't have the intrinsics to get a good quality up round done. And so, my encouragement to them is let's stay capital efficient in the interim. Let's get our intrinsics dialed in, and then let's potentially test the market, when conditions are a little bit more favorable, but more importantly, we have a full-fledged story. I'd say there's a second cohort of companies, though, that arguably do have the intrinsics. And I think for them, it's a lot about relationship development with the next set of investors, and it's about storytelling. And relationship development, I'm sure George and Cack, this is what they do for a living, and they're so great at it. From a storytelling standpoint, I think it's a very complicated market to tell your story in right now. I think there are any number of technology forces at play between AI and SaaS and cloud and infrastructure and open source, and telling a winning narrative, helping investors to understand why, amidst all of the noise and the hustle and bustle of all these different companies and technical forces, why you actually have a winning formula, why you have a business that can stand above the fray and potentially win your respective market. I'm finding that's very important to the next set of investors, and so I'm spending a lot of time with those founders just figuring out how do we tell that story. And increasingly, it's about adopting or appending AI to our narrative to make sure that both customers and investors understand why this is a business that can be future-proofed.
Interesting. Is it all changing your approach to investing at the earliest stages? Are you saying, okay, I want to hear that storytelling from day one, or we need to put more money into this company because I'm not sure when they're going to be able to raise next? So are there any kind of changes for that first initial investment that you make?
I think if there's anything that's changed about our founder calculus, we invest very, very early, often day zero, before there's even a product that's been built. And I think finding founders that maybe have maybe are default a bit more patient. Because I think this is a really complex market, and there are going to be any number of sine curves that are going to all kind of coalesce and converge, and just founders that are willing to grit it out and work through those forces. That's something that we're trying to pay a lot of attention to at Accel, and it's much easier to figure that out now. I mean, 3 or 4 years ago, in the height of the bull market, these funding rounds were happening in 48 hours. You had no time to build chemistry with the founder and really understand who they were from a values perspective, but I think we're getting a chance to do a lot more of that work, and we're trying to hone in on that.
Yeah. Cack, maybe with you and related to that, I mean, is the growth market stuck right now? I mean, are you active, and even kind of going on lines of what Vas said, like what's resonating with you to get you excited about doing a deal?
Yeah, short answer, I would say the growth market is not stuck. I think to your point at the beginning of, like the various data points you quoted, I think there's a really big difference between the averages and then the outliers. And in this business, like we are all, you too, are in the business of the outliers. Like we're all trying to find the 10 or 12 companies of consequence in a given year and a given vintage. And I think if you look at the averages alone, then it does tell the story of like growth is stuck and all these things are stuck. I think when it comes right down to it though, and you alluded, you have the companies that are a little bit stuck and then you have the companies that are working. Growth, there are definitely companies that are working. I mean, I think growth is stuck in as much as like the IPO markets are closed. So if we all look back to 2021, we had plenty of companies that went public. IVP, we had 15. You guys probably had 15 or 20 or whatever the number was. So there was liquidity was less stuck. But I think plenty of companies are performing tremendously well. And I think a lot of the incumbents, you alluded to AI already, like a lot of the incumbents are really well positioned to layer on AI. So companies like Notion and Ironclad's in your portfolio, right? Like I think they have notoriously done a really good job of responding to a change in the environment, that being like the advent of AI. We've done slight things to adjust to the market though. Like if we used to do more C's and D's, like we probably do more B's and C's. Like why do we do that? Because at the C's and D's, if these companies have raised a lot of money and then they've, their growth rates have declined commensurately, then the opportunity is greater at B than it used to be at D. That's what we're seeing.
And George, you just joined venture capital last year, right? So no.
I know where I stand on that new old paradigm here.
No, but you've been in the tech market since the late '80s, and I know you guys have been going extremely slow. I mean, this is the slowest that you guys have been investing your funds at this point. And what's driving that also? Why is it still after 18 months, 20 months, not picking up more steam?
Actually, there have been other windows where we've been as slow.
Okay.
And I think it's, slow sounds like we're not doing anything. If in any case, you get a little bit more agitated and like the hustle is super high in these environments to try to find those outliers with everybody else. But I think that in the growth stage, there are parts of the cycle where you want to be a little underinvested when FOMO is out and multiples reach 10x what they would historically get to. And then sadly, you would think that things would return to normal once the public markets readjust. But that time frame can take a long period to adjust. And that's what we're in the midst of right now. In the 2000 downturn, the markets peaked in March 13th, 2000, and they didn't bottom until Q4 2002. And that's for public markets. Private markets definitely lag significantly more. I'd say the good news for entrepreneurs is, as both us and Cack have said, the markets bifurcate, and there's a lot of money on the sidelines right now. It's still record levels of capital, so people want to be putting dollars to work. It's just so many of the good companies in growth raised and have a lot of capital left, so they don't need it. And we're all waiting and chomping at the bit to the point in time where they'll be coming back to the market.
Yeah. It's an interesting point because it would be great to hear, and I'm sure there's companies in the audience. On the one hand, they have that luxury of having a lot of capital, but there was a VC that said a lot of companies often, they don't die from starvation, they die from indigestion. So I'm curious, are you spending a lot of time with your companies telling them how to use that capital? Does it frustrate you to see that they're sitting on $200, $300, $400 million and just not really doing anything with it? Or are you just saying, hey, sit tight, we want to have that for a rainy day? I'm sure, given for all of you, it's affecting your company, so I would love to hear from each of you.
I mean, in the hierarchy of problems, I'd way rather have too much money than not enough.
Fair enough. But
no, I'd say in general, we're delighted. Like the companies that raised 200, 250, 300 in 2021 and thus have like many degrees of freedom with what they can do and not do, they are in much better shape.
But are you talking to them about using that capital, just sitting on, or are you spending more
No,
of
we
your
are
time?
talking about them about saving that money.
Okay.
I mean, certainly,
Okay.
I mean, in cases where companies are doing well, like absolutely spend it, but I wouldn't say that I am advocating on if in 2021 there was a lot of discussion of like, let's put money to work, let's grow faster, 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 that's not a aggressive position I'm personally taking at the moment.
I'd say there were so many growth stage companies that were burning 50, 100 plus million per year. Now everybody's been advised to just be more deliberate. But I'd say a key is you win by taking market share, right? And this is not a race to get to profitability for companies that are leaders in big markets and are showing signs of growing. There is a strong need to make sure you have some runway and good business unit economics. But I think, the narrative, it almost sounds like everybody's just, kind of hibernating to an extent. And I think it's really important that people be investing in AI initiatives to expand differentiation. And there are a lot of, positive trends and opportunities that are coming out of these waves. So I think sometimes the pendulum swings way too far when money is free and, people should be a little bit more capital efficient. And, now in an environment where everybody's saying capital efficiency, you want to make sure your foot's on the gas pedal in a responsible way.
Yep. And in the companies that you're dealing with as well, how do you think about that?
Yeah, I mean, on the early stage side, we did have some companies that raised enormous amounts of capital. I mean, there was one board that was on that I think the business was doing more in interest income than they were in actual like tangible customer revenue. And I think the coaching there is, and for a lot of these companies, is that fundraising doesn't equate to success and vice versa.
Yeah.
And I think the thing as board members we're all trying to be mindful of is that the capital shouldn't be burning a hole in your pocket, and it shouldn't be leading to bad behaviors or instilling undisciplined operating principles. And so I think just having really honest and cathartic conversations about that, and also I think to George's point, where there are, and Cack was saying this too, just there are productive ways to deploy that capital. And I think actually in this next year, it's going to be interesting to see, in an effort to grab market share, outside of just spending to acquire new customers, I think there's going to be a lot more private to private M&A, and you might be able to consolidate market share via buying the third or fourth place player in your category and buying revenue on the cheap, and you might be able to use some of that cash to do that. And so I think there are going to be some great discussions around that coming up in the next 6 to 12 months. But it all has to be in service of getting bigger and better as a company. And I think the sin was, a lot of companies that maybe used the capital and weren't getting bigger and better necessarily.
Yeah. It's interesting because we've done a lot of research in the past around companies acquiring companies before they go public and how it scales them up, makes them better, makes them more prepared. Are you not seeing that yet in terms of the companies using these large cash hauls to buy up companies, given the fact that you also have on the other side a lot of companies that are running out of money and need to make decisions about them being closed? Has that not happened yet, or is it just starting to happen? You think that'll be a big story next year?
I'm curious what you guys think. I think it's just beginning to happen. There was so much funding that went in 2021, 2022, and if you think about a round of funding roughly buying you 18 to 24 months, that puts the clock around the end of this year, early next year, when you have to think about the next round. And I think that's starting to catalyze the discussions on the boards of, okay, can we raise the next round? And if not, how do we potentially land the plane? And so it's certainly a conversation for a number of Accel companies where, hey, we're potentially subscale. We're the third or fourth player in the space. Maybe the category leader has just outraised us. They've outrun us. And so what do we do? And I think some of those conversations are just starting to happen in the background with investors going to investors. And I think increasingly some of the CEOs are going to start to participate in that. And I would expect a lot of that to happen in next year.
Yeah, I'd agree. So far, I've seen a real uptick in our companies looking to explore acquisitions. And they tend to be smaller ones, but at this point in time, given the demand environment, growth has been challenged, and everybody wants to be more than a one-trick pony in terms of a one-product company. So are there ways you could buy essentially a product team and spend less on the acquisition than it would take to, build out that product in full. And then there's a value proposition to the target, right? I mean, they can be part of something bigger potentially, but I'd say there are discussion levels. The private to private valuation discussions always, are challenging and difficult. But I think as the market kind of solidifies around its current zone, people will get reality.
I think on the bigger side too, you look at Databricks Mosaic and you contrast that with Adobe and Figma. And I think smart CEOs on the bigger side are going to realize, I mean, Ali from Databricks has, by his own admonition, like he can acquire companies if he's private and he can if he's public. So I think some of the later stage companies are going to do it just out of necessity, because once you flip public, with current administration, you probably can't make those same acquisitions.
So you mentioned about the ideal situation as being able to delay fundraising, but in some cases, obviously, you can't. And you have a number of companies who've raised at very high valuations, and they do need to come back to market. What are those conversations like with the CEOs in terms of the alternatives? Should they be doing that, and also messaging that to the employees? Because clearly that can be very sensitive when there's going to be a big downturn in the company and how that affects options. So I'd love to hear, how you guys are dealing with that, because I think that's obviously going to be happening more and more and more over the next year.
So I'll lead off here. So yeah, that's definitely a frequent conversation at this point in time. In general, our advice is if you need to raise and you can't have the luxury of kind of pushing things out, take your medicine and do what the market will bear. Find a good partner. While it will be dilutive and signaling down round sounds tough, they probably had a gift on the prior round, right? Try to look at it more holistically. The worst thing you can do is to run out of capital and not complete the journey. If we're an insider, try to tell our companies to avoid getting cute and thinking they can hold the last round with structure, because that creates misalignment around the board. In terms of communicating to employees, there's a little bit of a challenge depending on when people got their options, but I think that's happening everywhere, and you need to do what's right for the business.
Yeah, I think it's just having founders really internalize there's usually no secret option C. There's option A, which is go out of business, option B, which is raise money at a price that the market will bear, which could involve structure, but we would probably all tell them to avoid. But with that, you have to bring a certain humility, because there isn't going to be the white knight. There's no secret option over here. If there were, we would all have thought about it. So yeah, I think it's just an eyes wide open. And I think Bill Gurley has been really outspoken about the founders who are unwilling to accept that this is a new reality are the ones that are going to struggle in this environment, whereas the founders who just recognize, there are no companies trading at more than high growth companies now are, less than 40% growers. And, there used to be a whole high growth segment that doesn't exist anymore. So just, reacting to that reality, living that reality is probably a lot of what we message.
I think, I echo everything that Cack and George were saying. We've been almost conditioned to expect that valuation is this monotonic curve that only goes up and to the right. It never dips back down. But if you actually look in the public markets, any number of software companies have raised or done secondaries or issuances or debt rounds all along the valuation curve. And that's just the reality of funding for large public SaaS companies. Why isn't that the reality for private SaaS companies as well? And so, it's about getting the capital that's required into the business at the least dilutive terms possible. And that's just going to look different across the life cycle of a business, especially a business that you're theoretically going to hold for 10 to 12 years. I mean, you're going to experience one, if not two economic cycles within that holding period. And so I think founders, and we as investors probably did a disservice to the founders that we're working with just to only ever expect rounds to go up and to the right. But I think if you look at other corners of finance, that's just not the case.
Mm-hmm. And it's interesting, Cack, you alluded to it about growth and this 40% growth. I mean, people talk about rule of 40. Is rule of 40 now rule of 50? And is it interesting to have a 20% grower with a 20% profit? Would you rather have, the 40% grower, where that's break even? I mean, how do you think about that, particularly for the companies that, again, you hope will go public in a couple of years? Is there particular, again, because I know the CEOs here are hearing about these numbers, rule of 40, and rule of 50, choose a lane. Where do you want to see your companies?
I mean, I'd sort of echo what George said. I mean, we're entering at Series B and Series C, as you are. You're seed and Series A, but Accel does a little bit of everything. Like at Series B and Series C, am I looking for companies that are 20% growers? No, absolutely not. I'm looking for companies that are tripling and quadrupling, and that doesn't change. I think, yeah, if it used to be like grow at all costs and now it's be profitable, like I think both of those are wrong, and it's somewhere in between, and we over-rotate on both sides. I think but like at the margin, our graduated companies that are, within 2 years of an IPO, like what are we telling them? We're telling them to be a little bit more discerning about spend. Because if that's realistically what the public market buyers are interested in, then again, but that's like very much at the margin. Because Klaviyo, that's you guys, they're still growing really well. And I think that's what appeals to the public markets. And so I think we'd be doing everyone a disservice if we told them to just like over-optimize for. But
it might be err a little bit more on the side of growth, is what you're saying? Again, thinking that the ones that are closer to an IPO?
I mean,
Yep.
Go ahead.
I mean, I would definitely say we have a bias for growth. And if you look historically, it's probably a 2/3 weighting in the public markets towards growth, 1/3 on efficiency, and having that kind of balance makes a lot of sense to us.
I think there's another dimension to setting up companies that are aiming to go public, and it's about predictability. And if you look at the companies that had the most volatility and price swings in their shares this year, it was companies that were either decelerating ahead of market expectations or accelerating ahead of market expectations. Obviously, the latter is a good problem to have, but to be able to forecast your business and actually really be dialed in as it relates to the intrinsics, I think that's increasingly going to matter. And it may not be about intrinsic profitability out of the gate, but do you at least have line of sight to the entirety of the P&L converging within a couple quarters? Mm-hmm. I don't think that public market investors are willing to underwrite burn into perpetuity with no end in sight, but if you have a planful way of saying, hey, this is the amount of capital that we're going to spend because we're going to grab this amount of market share, but it should all converge within this time period, and here are the bookings expectations I have on the quarters therein, I think that's a really solid story, and I think public market investors are eating that up right now.
And I'd say I think it's a really tough time if you're a private company to feel like you've got that predictability right now as a snapshot in time, but we're starting to see some signs of stabilization as of Q3, both in the public and private markets, at least on some of the net expansion ratios. A lot of the optimization started 4 quarters ago. So hopefully some of that's played through the system and we don't see a continued decline on NRR.
Mm-hmm. So just, in terms of the public markets and to kind of set the perspective here, I think, going back a couple of years ago, everybody talked about hitting, 100 million in ARR, maybe not even revenue, you could suddenly become a public company. We don't know obviously when the public markets are going to open, but assuming 2025, 2026, where do you think the companies are going to have to be in terms of size and maybe even profitability in order to go public? I imagine it's no longer 100 million in ARR.
Yeah, I'd say there's so many, quote, unicorns that are out there with some significant heft. The first ones out the door are going to look like Klaviyo. I mean, almost like they check every single box. They're perfect. And then once those perform well and probably driven by rates coming down and growth being back on in the public markets, you'll start to see a wider aperture. But I do think these public buyers have such big assets under management that they're going to require a certain amount of float so that they can put dollars to work. And then given the low valuation multiples or the normal valuation multiples, it'll probably inform $200+ million ARR rates to get public.
I think for what's worth, that's an interesting conversation that I'm observing in some companies where, we might be at $40-50 million of ARR. We probably have line of sight to getting to 100, 150, but to truly have a public story, I think you have to be minimum 200, maybe 300, 400. I mean, Klaviyo was 550, 600 when it went out. And so the substance of the business just has to be so much more significant than it ever was before. And I think as founders, as investors, as board members, the pragmatic thing to do is we have to figure out, well, do we have the legs to get there? What's the team required to get there? What's the dilution that we're going to take from both fundraising as well as options to be able to see this all through? Is the market size really there? And if not, that's okay. But let's be pragmatic and open-eyed about that. And there are going to be any number of other paths to realize the value in this business. And Cack was talking about some of the M&A that's happened this year. Atlassian just bought Loom for $1 billion. I mean, those are. We have forgotten the days when those were actually really great outcomes, and those are great for the employees, they're great for the investors, and they should be celebrated. And I'm excited to see hopefully that part of the market come back.